filmed this video today to assure and help all of you who might be struggling with seeing rate in your portfolio. For many of us who have been investing for several years now, this is actually pretty common. But if this is your first time seeing rate, here's what you should know and what you might want to do. Now, the problem with investing in anytime in the last 2 years, if that was when you started, was that many investors actually became overly confident due to the bull market. Now that the bear market is here, what should you as an investor do? And if you're new, what would be the next step for your portfolio? So here are a few mistakes that happen. First, many people actually put their money into stocks with lofty valuations. If that's you, make sure you know how to calculate valuations and what stocks are worth from now on. Number 2, many ignore diversifications as they hankered after concentrated portfolios shown by that of YouTubers who made their riches from just a small handful of stocks alone. Now, we cannot deny that in investing, both luck and skill comes in place. A concentrated portfolio may be able to help you to magnify your returns, but if during periods like this, it also magnifies your losses. So you want to be careful and really think about whether you're suited to have a concentrated portfolio or if diversification might be a better way to go. Next, number 3, many people, especially the new ones, started to look down on value investing as old school or outdated. Okay, value investing does have a good strong suit. If you're able to identify fundamentally strong companies that are trading for less than what they're valued, it's always a good investment idea. Number 4, you may have seen that famous Reddit meme of stocks only go up. That is not true. Stocks can go to zero. Stocks can get delisted. They can fall 90-95% and you could end up losing a huge bulk of your capital. So don't believe memes like that. Next, the biggest mistake was that many new investors started getting greedy and used leverage to magnify their returns. Leverage is a double-edged sword. You can earn a lot more from it, but when you lose, you also lose big. And if you lose so much that you're unable to get back into the game after, that is going to be a big problem. And after all, a rising tide lifts all boats. But like what Warren Buffett famously said, it's only when the tide goes out that you realize who has been swimming naked. So if you're a short-term investor, this could be bad news for your portfolio right now. But if you're a long-term investor, such pullbacks like the ones we're seeing now would actually represent attractive buying opportunities. So what can you do? What are some solutions that you can implement? First, you might want to start re-looking at your portfolio allocation. Maybe you're feeling that anxiety right now because your portfolio is overly exposed to a certain industry or you're too heavily concentrated in growth stocks. If that sounds like you and you're feeling uneasy, then you might want to review, rebalance, and possibly reallocate. Next, you also want to make sure that you actually focus on looking out for undervalued stocks. Due to the broader market decline, even fundamentally companies have been sold down in this climate. This is actually a really good time to start hunting for undervalued stocks, such as companies that are trading for less than what they actually were. Some common metrics that you can use to all look at include price-earning ratio, price-to-book ratio, or even net asset value. Just make sure that you use the right metric for the right industry and company. Next, do not try to time the market. Not only is it an almost impossible task, it's also really hard to get it right all the time. So rather than trying to put all that stress on yourself, why not just do regular dollar cost averaging instead? DCA is a really good and stress-free, fast-free strategy that can help you to reduce your cost per unit basis. And if you've identified a fundamentally strong company but paid a high price or high valuation for it, DCA can actually help you to bring down your cost per unit. So this is also more I mean, this is also less stressful for you because it doesn't require you to have to react immediately to market events or changes. And the final tip I'll give you guys is conserve your bullets. Because if the current market climate persists, or if the war drags on, if we enter stagflation, if inflation becomes even worse and rears its ugly head, investor sentiment towards growth stocks become muted, or even worse, with rising interest rates, those start going down even more. Regardless of the scenario, which no one can predict, what we know is that if the market continues its downtrend, you need to make sure that you have sufficient cash to continue deploying at every turn and average down. And the only way you can do this is if you have fresh capital coming in. You want to make sure that you have income coming from other sources, such as from your job or from your business, so that you have fresh capital every single month to deploy into your strongest picks with the most conviction. So be sure to implement these tips. If you found this video helpful, be sure to like and subscribe so that I know that you appreciate this and can focus on doing more such videos to help you guys through this journey. My name is Dawn and I'll see you in the next video. Bye!